have said before that I rather like rights issues if the money raised is used to generate more income for investors. In the latest fundraising exercise by IREIT Global, this seems to be the case. They are proposing to acquire 17 retail parks in France. A strong reason to invest in these assets is that this retail format will continue to outperform in the context of global inflation partly caused by the COVID-19 pandemic. The popularity of hard discounters, and outlet stores in France has risen exponentially in recent years. Retail parks, an out-of-town asset class, have been resilient through the COVID-19 pandemic due to their accessibility, open-air format, wide range of available spaces, parking facilities, manageable operational cost, value for money brands, and for some retailers, omnichannel experiences. These 17 retail parks are leased to B&M Group, a European discount retailer listed on the London Stock Exchange with a market cap of about £4.7 billion. They have been occupying these assets since 2005 on average. There is a weighted average lease expiry of 6.8 years, but there is an option for lease break 4.6 years from now. A combination of competitive rents due to out-of-town locations and a resilient retail model which is discount retailing suggests to me that this is a good investment. Of course, all investments are good investments at the right price. The asking price is approximately $112 million. This gives approximately 1.7% discount to the average of the two independent valuations of approximately $114.1 million. The price is very close to valuation. Although this might suggest that we are not getting a fantastic deal, it also suggests that these kind of properties are probably in high demand. The seller isn't desperate to sell. However, similar to the purchase of Woolworths HQ in Australia by AIM's APAC Real Estate Investment Trust, I like that these 17 properties in France have excess plot ratios which could be developed for more rental income in future. I would take this potential into consideration since we should always have a long-term perspective when investing in good income-producing properties. So, apart from rental escalation being pegged to inflation, this could be another way to extract more income from the assets. When we take into consideration that new developments of such assets are being restricted in future due to new French regulations, these assets will become even more valuable in future. This reminds me of IREIT when its properties were valued at under replacement cost. No one in his right mind would construct a new building when buying an old one would be much cheaper, and would give similar or higher rental yields. So, the assets IREIT was holding were undervalued. In the case of out-of-town assets in France, new ones are apparently not allowed by law. With the future in mind, we could make the case that these assets could be undervalued. Of course, having these properties in the portfolio would reduce concentration risk, which has been a major pain point for many investors forever. I don't really care for the other advantages put forth by the management. The next thing I want to know is how the acquisition is going to be funded and whether it is going to be yield accretive. Apparently, it is going to be yield accretive. Pro forma adjusted FY 2022 accretion of 2% was computed based on audited FY 2022. This is with the assumption that Darmstadt campus is 100% vacant for FY 2022 from the 1st January 2022 with nil revenue, but with operating expenses. Okay, how much do investors have to pay? Cost of properties $112 million. Expenses related to purchase $20 million. Now, I know how people paying ABSD in Singapore feel. The deal will be funded by the following. 1. A non-renounceable underwritten preferential offering of new units to existing unit holders on a pro rata basis, or a rights issue. 2. External bank borrowings. 3. Borrowings from Tikehau Capital. Both Tikehau Capital and City Developments Limited, the joint sponsors, and the manager, will subscribe in full their allotment in the rights issue. They will also subscribe to excess units which other investors do not take up, such that their aggregate subscriptions would amount to a maximum of $40 million. IREIT Global has a market capitalization of around $550 million. As the sponsors jointly hold about 50% of the total units issued, without further information, I can only hazard a guess that we would see around 10% increase in the number of units issued. We could assume that approximately 168 million new units might be issued at an illustrative issue price of 45 cents per unit. This could raise gross proceeds of approximately $75 million. So, if we like this proposed investment in French retail parks, we have to be ready to increase our investment in the real estate investment trust by about 10% through the rights issue. If AK can talk to himself, so can you.